most traders fall for it at least once. The hope for a decent move up, back to its upper channel, is returning. And just when most of us are all in, the market flips. It crashes hard, sometimes up to 60%, all within a few days. That, my friends, is what we call a dead cat bounce. So what does it mean? A dead cat bounce is a short-lived recovery in a falling market. It looks like a comeback, it feels like hope. But it is often just the setup for another painful drop. The idea behind the name is simple. Even a dead cat will bounce if it falls from high enough. In crypto, this trap appears more often than people might think. It tricks traders into believing the bottom is in. They start buying with confidence, thinking they are early. But what they are really doing is catching a falling knife. And yes, I have been there myself. Not long ago, I jumped back into the market during what seemed like a perfect backtest. I saw a potential bullish correction, and influencers were calling for much higher targets than mine. So I followed the crowd and went back all in. A few days later, the market dropped by another 15%. Trust me, it really hurt, but it taught me a valuable lesson. In crypto, not every bounce means a recovery. Sometimes, what looks like strength is just fear wearing a mask. So stay focused, and do not chase green candles. If this story helped you, like it, share it, and send it to someone before they fall for the next bounce. Subscribe right now and hit the notification bell, because I post 2 tutorials like this every week. And follow me on X for daily free crypto news updates. Thanks for watching. And stay tuned because in my next tutorial, I will share more ways to master crypto trading.